To kick things off, let's set the stage. When you sell a property, the taxes you might owe depend largely on whether it was your primary residence or an investment property. In this video, we'll simplify the rules, highlight the powerful Section 121 exclusion, and clear up common myths about 1031 exchanges. First, we'll map the critical distinction. Then we'll show examples, step-by-step math for your adjusted basis. And finally, we'll test your knowledge with quick quizzes. Next, let's frame the most important decision: classification. If you lived in the property as your main home for at least 2 of the 5 years before the sale, it is generally a primary residence. If you rented it out or used it for business, it's an investment property. This distinction unlocks entirely different tax tools, so we'll build from here. Moving forward, here's our roadmap. We'll classify your property, explore the Section 121 exclusion, compute adjusted basis step by step, clear up 1031 exchange confusion, walk through examples and comparisons, then finish with key takeaways and action steps. Now let's apply a quick test. Ask yourself whether the property was your main home for at least 2 of the 5 years leading up to sale. Yes. If yes, it's generally a primary residence. If not, it's treated as an investment or business property. Primary residence status opens the door to Section 121, which can exclude a substantial amount of gain. By contrast, investment property may allow for a 1031 exchange, and it can trigger depreciation recapture. Keep documentation for primary residence, such as driver's license address, voter registration, tax returns, and utility bills, because these can support your position if questioned. Continuing from the quick test, this decision map branches from the central idea of selling property to the 2 major categories. On the primary residence branch, the map emphasizes the 2 out of 5 year test, the Section 121 exclusion thresholds, the need for ownership and use to total 2 years, and a reminder that you generally cannot have used the exclusion in the prior 2 years. It also lists examples of documentation that help substantiate primary residence status. On the investment property branch, the map highlights eligibility for 1031 exchanges, the critical 45-day identification and 180-day closing timelines, the need for a qualified intermediary to handle funds, and the presence of depreciation recapture. The aim is to visually separate the rule sets so you can navigate confidently. Next, let's focus on Section 121, often called the home sale exclusion. If you're married filing jointly, you can typically exclude up to $500,000 of gain from federal taxes. Singles can exclude up to $250,000. To qualify, you usually must have owned and lived in the home for at least 2 years during the 5 years before the sale, and you generally must not have used the exclusion in the previous 2 years. This exclusion overrides the typical long-term capital gains tax on the excluded amount. Keep in mind that state tax rules can vary, so it's important to review state-specific guidance. Then, let's cement the concept with examples. In the first row, a married couple sells a primary residence purchased for $400,000 with $50,000 of improvements and sells for $900,000. Their adjusted basis is $450,000. The gain is $450,000, all of which is excluded under Section 121, leaving no taxable gain at the federal level. In the second row, a single seller bought for $300,000, added $30,000 of improvements, and sold for $600,000. The adjusted basis is $330,000, so the gain is $270,000. Because the single exclusion cap is $250,000, $20,000 remains potentially taxable. In the third row, a rental property was purchased for $350,000, improved by $20,000, and sold for $600,000. The adjusted basis is $370,000, leaving a gain of $230,000. Because it's an investment property, there is no Section 121 exclusion. The entire gain is potentially taxable and may also include depreciation recapture. Note that these are simplified examples and do not factor in selling costs, potential depreciation adjustments, or state taxes. After seeing examples, here's the step-by-step method to compute your adjusted basis. First, start with your original purchase price. Next, add certain capitalized closing costs where appropriate. Then, add the cost of capital improvements, such as a new roof or a permitted remodel. After that, subtract any depreciation you have claimed if the property was used as a rental or for business. The result is your adjusted basis. Now compute gain by taking the sale price and subtracting selling costs like commissions and transfer taxes. Then subtract your adjusted basis. If the property qualifies as a primary residence and you meet the rules, apply Section 121 to exclude up to the allowed cap. If it is an investment property, consider whether a 1031 exchange might be appropriate and account for potential depreciation recapture. Now, let's address a common misconception. A 1031 exchange is not for primary homes. It applies to investment or business property and allows you to defer, not eliminate, capital gain by rolling proceeds into another like-kind investment. The deadlines are strict. You generally must identify replacement property within 45 days and complete the purchase within 180 days. A qualified intermediary must hold the proceeds. You should not receive or control the funds. If you are selling your long-term home, Section 121 is typically the relevant exclusion, not a 1031 exchange. Meanwhile, here's a quick comparison. On the primary residence side, the 2- and 5-year test and Section 121 exclusion are central. A 1031 exchange does not apply to selling your home. Emphasis is on proving primary use with documentation. On the investment side, there's no Section 121 exclusion for typical rentals. A 1031 exchange can defer gain, but there are strict timelines and a requirement to use a qualified intermediary. Depreciation recapture is often part of the tax picture for rentals. Next, visualize the sale proceeds. The largest slice is often the adjusted basis, representing what you originally paid, plus improvements, and adjusted for depreciation, if applicable. A substantial slice can be the excluded gain under Section 121 for a qualifying primary residence, which you do not pay federal capital gains tax on. The remaining slice is taxable gain, which may be zero for many sellers of primary homes, but can be significant for investment properties, or for single filers whose gain exceeds the cap. The exact proportions vary with each transaction. Now, let's test your understanding. The question is, you and your spouse lived in your home for 3 of the last 5 years and are selling for a $420,000 gain. How much of that gain is typically excluded from federal tax under Section 121? Option A, $0. Option B, $250,000. Option C, $420,000. Option D, $500,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $420,000. Because a married couple can exclude up to $500,000 under Section 121, and the gain is below that cap, the entire amount is typically excluded, provided all qualification rules are met. Next, here's another quick check. Which strategy is appropriate for deferring gain on a rental property sale, not a primary residence sale? Option A, Section 121 exclusion. Option B, 1031 like-kind exchange. Option C, mortgage interest deduction. Option D, first-time homebuyer credit. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the 1031 like-kind exchange. This mechanism is designed for investment or business property and allows deferral of capital gain if the strict identification and closing timelines are met and a qualified intermediary is used. It does not apply to the sale of a primary residence. As we begin to wrap up, remember these key points. First, classification comes first and determines which rules applies. Second, Section 121 can exclude substantial gain for qualifying home sales, $250,000 for singles and $500,000 for married couples filing jointly. Third, compute adjusted basis methodically. Purchase price plus capital improvements minus depreciation. Fourth, 1031 exchanges are for investment property only and require strict adherence to deadlines. Finally, maintain strong documentation and consult a qualified tax professional before you close. Before we conclude, a brief but important note. This content is for educational purposes only and is not tax, legal, or financial advice. Tax outcomes can vary depending on your state and your personal situation. Always consult a qualified CPA or tax professional prior to closing your sale to ensure compliance and maximize your savings. To summarize, start by deciding whether your property is a primary residence or an investment. Apply Section 121 if you qualify. It can eliminate a large portion of your gain. Calculate adjusted basis and gain carefully. Avoid misusing the 1031 exchange for primary home sales. It belongs to investment property strategy. Finally, consult a professional before you sign closing papers. As a final note, if you found this helpful, please like the video, share it with someone who's selling, and subscribe for more straightforward money guides. In the comments, tell us your biggest question about home sale taxes so we can cover it in future videos.